What's up, YouTube? Eric here. Last month we did a video like this and it was really popular. Let's keep that party going and do it again. So we did 10 best stocks, 10 best dividend stocks for June. I'm going to do a video today that's going to cover 10 best dividend stocks for the month of July. And I'm going to get right into it, the first pick. Now I drove all the way across the state of South Dakota. I drove all the way across the state of Montana. And I'm telling you what, one thing that we saw over and over and over again, I'm talking working on the side of the road, being hauled on huge semis, new and old, a lot of new, brand new $1 million machines were being shipped all over. And I keep seeing these everywhere I go. I see green, and that's John Deere green. And I tell you what, this was just a great opportunity below $300. It's popped nicely. It's up 3.5% today. It got down to around $285, maybe a little bit less, 282. Looks like 283.81 is actually the 52-week range. So it just got down below 285. It's already back close to $300, but it's still attractive even here. This is John Deere, ticker DE. PE ratio is a 15. Dividends a 1.56%. Now the thing about John Deere, guys, it fits in the industrials bucket, and you might not have a lot of industrials if you're a growth investor. It's a great one. These guys are getting more in the tech stack. I mean, this right here, accelerating precision and automation while driving efficiency. Full set of technology required to help customers increase productivity, profitability, and sustainability. This is going to be huge. I made a video last summer. It was basically the Tesla of farming, and it was about John Deere, talking about autonomous tractors, drones, all kinds of cool things. Autonomy, connectivity, guidance. They're even going to have software as a service as part of the business. You can see the layout here with hardware and guidance. They made some acquisitions like Bear Flag Robotics for autonomous solutions. This business, this company, they have a lot of great things going for them. You think about precision agriculture, but they also have the small ag and turf. They've got construction and forestry. And actually you see some of the John Deere machines that are actually not green. They're yellow. It's kind of look like Caterpillar. One thing I want to say about this is if we go into recession, industrials like Caterpillar, like John Deere, they do get hit. Those are going to be impacted. But if you look at the stock, it's kind of already been hit pretty hard. I could see that stock going as low as $250, but I'm telling you, DCA under $300. I think long term, if you're holding this for 5 or 10 years, high quality blue chip company. Company's been around since the late 1800s, and I think it's going to do very good things and actually behave like a DGIF, dividend growth investing for fire. It's going to give you some growth on the share price. I think you're going to see revenue acceleration, and I think they're going to continue to grow that dividend as well. So the first pick, no particular order here, John Deere, ticker DE. Now, I did finally nibble a little bit of this in the portfolio last week. I have a starter position now of Intel. When it got below $36, I bought it at $35 and change. It got down to $35.54. I think mine was closer to $36, $35.97. But a dividend yield, 3.95%, PE 6.14. I'm not saying this is a growth stock. This is going to be much more of a dividend DGI income type stock where you're not going to have a lot of growth of the company. This is going to be a recovery story that could take years. You're going to collect a dividend and slowly build a position. I'm going to be targeting this for my end game portfolio, $5 million portfolio with passive income. This is going to be part of that solution. And I'm hoping for good things for Intel. We really need Intel to do good things to really make us more competitive. When you think of the foundries, you think of Taiwan Semiconductor and Samsung. We need more competition for companies like Intel. So I'm rooting for Intel. I've been following the stock for a long time. I think it finally at 6 PE got to a point where I thought it was attractive enough to add for that dividend. Now the risk is if they cut the dividend, the stock could get hit harder. But the thing is, 6 PE, again, not growing, but I think it's attractive below $40, especially if you can get it 35, 36 or less, like I got in that range, and really think long-term, a multi-year recovery play. I was hoping the stock would get below $100. I was probably getting a little bit greedy on the bear side. I got to 104.72. It's already back to 117. It's still under a 10 PE ratio at 9.45, paying a 4.1% dividend yield. This is TROW price. Now, when you look at this, it's a $26 billion mid-cap type stock. And you say, why did this thing get hammered so hard as a financials type company? Well, the reason for that is they were tied to a lot of those technology IPOs, so they got hit pretty hard. I think at this point, 4% dividend yield, that yield looks very safe. I think it's very attractive to start accumulating, especially if you need an income type stock. Check out TROW price, ticker TROW. This one is a bit of a risk. Now, they have it labeled here in Fidelity as information technology, but I think it's really more of a consumer discretionary type play. You think of Logitech, people are going to be buying peripherals. Obviously, it's going to be for business and for personal, but when you think of like this camera I'm talking about, it's a webcam, it's a Logitech webcam. You know, you think of mice, keyboards, things like that. And you think about consumer spending, consumer discretionary, this could get hit hard, but it already has. It's down 58% over the last 52 weeks. 13.6 P ratio. It's attractive. It has a safe 1.92% dividend yield. You look at the dividend safety score, it looks very solid. Mid cap, $8.5 billion market cap. And if you can get this thing, especially if it gets back below $50, it was at $49.70 on July 5th. I think if you can accumulate in this range and lower dollar cost average, this is one where, 2% dividend yield, if you're holding the stock for several years, it could be a good one. Build some dividend income, have some diversity into other areas if you're trying to diversify your portfolio a little bit. So this one could have some additional risk, but I do like it in these price levels under $50, Logitech. This one is the epitome of an income stock, something that you really hold to collect yield. Pays a 4.27% dividend yield, and that is a monthly. So they pay dividends every month versus every quarter. So it's nice if you're living off of dividend income, passive income, to give you a little bit of stability for that monthly income. This is Realty Income Corp. Ticker is O. Large cap, $41 billion, 4.27% dividend yield. And this one, I want to show you really quick what they're all about. So this is an S&P 500 company, one of 65 companies in the elite S&P 500 dividend aristocrats. Top 10 global REIT. DGI investors love this stock. 15.3% compound annual total return since going public in 1994. That's impressive. 4.4% compound annual dividend growth rate since 1994 and 115 dividend increases. Of course, if you're using that dividend income to live off of, you want that to increase. You want the increase of the dividend each year so that you're outpacing inflation. This is one of those companies that's going to help you do that as a dividend aristocrat. They want to be a top 5 global REIT, consolidate $12 trillion global REIT. So when you look at this, guys, they're doing leases for companies like Starbucks, Walmart. They're ones that, even though it's tied to retail, I think of this as much safer than a lot of those other REITs out there. 78% is retail, 16% non-retail, 6% other when you look at their portfolio. They have 1,090 clients, 70 industries, 50 different states, as well as Puerto Rico, Spain, and the UK. And if you look at this, they've got $5 billion in the European portfolio. They're diversified, somewhat international, not huge international presence, but they do have some international presence. And this is, you look at CVS Pharmacy, you look at, 7-Eleven, you can see some more here. You've got Walgreens, AMC, FedEx, Tractor Supply Company, Home Depot, some great companies on here, Dollar General. You can see it's pretty diversified. So grocery stores, 10%, convenience stores, 9%, and so on, theaters, 3%. You can see here, pretty good diversification when you look at everything from home improvement to casual dining and so on. Their top 20 clients are highly insulated from changing consumer behavior. These are businesses that have less impact if we go into a recessionary type period. They'll have some impact, but not as much as other areas. This is one that I'm also going to be using in that endgame portfolio as an income stock. This is Realty Income, ticker is O. A little bit of a curveball here. This is going to be consumer discretionary. It's been hit pretty hard though, down 20% over the last 52 weeks. Now it has recovered pretty nicely off the lows. It was about $324 here back in May. It's now $376. This is Pool Corp. PE on is about 21, 1% dividend yield. This is a true DGIF stock. If you're not familiar with Pool, they're based in Louisiana and they distribute swimming pool supplies, equipment, and related leisure products in the United States as well as internationally. They offer maintenance products, chemicals, supplies, pool accessories, repair parts, filters, replacements, pumps, and so on. Now the fear, of course, here, if you look at a recession, people aren't going to be dropping a bunch of money on a pool. Okay, so it's notable, it's understandable why the stock is down. I think it could go back to that 324 level, maybe even 300. I would want to buy this stock lower than 376. It's one really to watch at this point. It does have some additional risk because it's consumer discretionary, but I do like this if you're thinking of a long-term play and you're trying to get into it as an entry point. If it gets back down in that 325 range, I think it's attractive there. They still are growing quite nicely. And if you look at like my neighborhood, for example, we have a community pool. I have an association, we have a shared pool. More and more of my neighbors are building in-ground pools in their backyard, private pools. And really a lot of that came from COVID, people just being locked up. They wanted to have something to enjoy at their home, to have entertainment with, etc. And you're seeing that carry through a little bit. So there is some risk there, but when you look at the numbers, you look at the last earnings call, the growth, some of the things that are doing, it looks pretty solid, especially like I said, if you can get it below a 20 PE ratio, there is some risk there, but I like it. Pool Corp, ticker is just Pool. I recently did a video about this mega merger with Broadcom and VMware. I think it'll be an interesting one to see how it plays out. Has to get approved still through antitrust and all that, but Broadcom, ticker AVGO, solid 3.4% dividend yield. It just bounced nicely, probably 5% off of its recent lows. It was actually down even more than that when semis got crushed. The reason semis are doing a little bit better today is Samsung actually had a decent earnings report, and it's pulling a lot of those semiconductors higher, and the markets are kind of rallying. But Broadcom, I still like this one even at these levels. I think this acquisition could be interesting with VMware. 3.4% dividend yield. That is a safe yield that they're committed to. Broadcom. This is one that I've never covered on the channel before. $86 billion large cap, ticker is CI at Cigna Corp, 1.6% dividend yield, around a 17 PE ratio. This one came up when I did a DGIF search. This was actually a pretty solid one in terms of growth. When you think of the growth of the dividend, growth of the share price, revenues, they seem to be doing good things. If you're not familiar with what they do, they provide insurance and related product services in the United States. So they've got a range of coordinated and point solution health services, including pharmacy, benefits management, care delivery and management, intelligent solutions, and so on. So you think of this, it's a healthcare related stock, large cap, $86 billion. I think it's a solid one to explore. I wanted to get some more healthcare in here. Cigna Corp, ticker CI. It can be really tricky to time the bottoms on some of these. You know, Microsoft just got down to $241 not too long ago. It's already back to $267. But I look at it here and say, it's attractive still, these prices. Obviously, if we get back below 250, I think that's a no-brainer buy in my opinion. Right now, it's a 28 PE ratio, which you could say is expensive, but very impressive growth, very stable company, going to be doing great things for a long time. You think of Azure, you think of cloud, you think of all the different products, you think of endpoint security. There's so many different things that they have their hands into. You think of Xbox and gaming. They're going to try to acquire Activision Blizzard here, which could be huge for them longer term. It is a smaller dividend. This is a DGIF stock, so a little bit less than 1%. It pays a 0.93% dividend yield. And you can see it's a very large cap, you know, $2 trillion type company. You say, well, Eric, it can't really grow much more. This thing's a beast. I've owned this stock since the, 30s. I've got a 6.5%, 7% yield on cost, something like that on this stock. And I think it's going to do great things longer term. It's down 4% still over the last 52 weeks, so you're getting an opportunity to accumulate shares. I think these levels are attractive, especially 250 and lower on Microsoft. Now the 10th pick is a curveball. You know how I like curveballs. Before I announce that 10th pick, I do want to let you know that this video is sponsored by The Motley Fool. If you want to see the 10 best stocks to buy now, visit fool.com/firedupwealth. And if you have not subscribed to the channel, please do that now. Click subscribe, that little bell to get notifications. Click the like button, drop me a comment, helps me out a lot. So the 10th pick, guys, this is a curveball. What is it? Now I get it. You might look at this and say, this is boring. Why would I want to invest in something like Tempur Sealy International? Mattresses. It pays a 1.83% dividend yield. It's a 7 PE ratio. And it's one of these things where it can be impacted by heavy recessions. If you look at the last recession, it did have a little bit of a pull down, but it's down 46% over the last 52 weeks. And these guys have tremendous market share. It's a $3.8 billion small cap. I get it, not a growth company or anything like that, but strong balance sheet, strong cash flows, very safe dividend. I think there's some opportunity with this internationally as well. Right now, they have 31 North American facilities and 38 international facilities. And I'm not going to spend a lot of time on this, but I also think another opportunity here is this Stearns & Foster. I believe this is what we have for our mattress. They want it to be their next $1 billion brand. I know they were selling a lot of those through Costco, but I do like this one a lot, guys. Potential, it's a DGI, DGIF type hybrid play. When you look at the growth, they're doing more with direct to consumer. In fact, 52% compound annual growth rate when you look from Q1 2018 to Q1 2022. But check this one out, guys. A little bit of a curveball, but TPX. I appreciate your time and attention. I hope you have a great rest of your day. Take care.